Hello, wealth catchers. Welcome back to the channel. Hopefully, you guys have been having a good week up until this point. I do know that the market has definitely been bleeding, so portfolios aren't looking too good, but hopefully, you know, you're having a good week so far out, regardless, outside of the portfolio and outside of, watching your investments. Hopefully, you're doing well. So this video, we're definitely going to go tap into on like the health of the market sentiment. We're going to go over all the major indices. We're going to touch on fear and greed, the inflation report, and also the Fed Watch tool. And for the tickers, it's going to be all the major indices. So your Dow Jones, your NASDAQ, S&P 500, your small caps, RSP. I'll definitely look at that. Gold, silver, and we're also going to close out with Bitcoin. So if you like this information in the video, leave a like, comment, subscribe, all those good things. Share the video out. Definitely appreciate it. So without further ado, let's go ahead and drive right into it. So obviously we're going to start off with the fear and greed index, right? So fear and greed, as you can see here, if my thing actually scrolls down, we're currently at 28. So fear and greed's at 28. Obviously that means fear. And as we've talked before in the past, usually around those 30s, and anything below that. So once you start getting to 38, 37, lower into your 20s, into your teens, those are opportunities you can probably start looking at, like building a position or start hunting, start fishing around for names that have, been mispriced or the market has fallen out of favor with. And we are definitely going to see that we have some opportunities, whether you're paying attention to, software, tech. Obviously, a big part of this sell-off has been a lot of tech, a lot of AI names, which obviously makes sense because they were the major catalyst in the rally, right? So, and obviously, we have a whole bunch of things going on that's affecting this drawdown or this pullback right now. There's nothing too crazy in terms of, you see the headlines or $1 trillion mark wiped out in the market, things like that. And then you see the next day $1 trillion added back to the market. So it's the whipsaw. So those type of headlines, the news will get to you, things like that. But stay the course, follow your plan, how you have it, delegated and designated for what you're trying to do and accomplish. But moments like this, also don't forget why you're investing for the long term. For trading, yeah, it probably sucks, but for the long term, it's just again, as we always say, it's a blip on the graph, right? But it's a blip that you could use to your advantage. You use that to go ahead and find your opportunities. So again, fear and greed index pushing that 28 we see here. So obviously market sentiment is at fear. And then back to this trusty indicator here, when we're looking at the S&P 500 versus its 125-day moving average. So many videos back earlier this year, we talked about how we were right, excuse me, around March 5th, we were right here above the line. And then we took that dip and then we traded beneath there for a few days. Excuse me, let's get a sip of water real quick. Sorry about that. But yeah, so we saw that and then we traded beneath it and we kind of bottomed out right around here, March 27th and March 30th. It's kind of where we bottomed out at. And then the market started running up towards the upside, right? And we blew past that moving average. So it hit new all-time highs, obviously. So it seems like we are slowly treading back down towards that 125-day moving average. We'll see if that fully happens, but it's the fact that we are quickly approaching it too. Like, because also the market didn't drop down. How can I say? It didn't drop down by like small increments. It was kind of like some heavy sell-off, some heavy drops, especially for people who are concentrated. Like taking a look at my son's portfolio, we kind of are running a concentrated portfolio there. So we're talking about like, swings of $100, $200 swings in the portfolio to the downside. Obviously, we enjoy that also to the upside. But again, what happens on the upside could happen on the downside and vice versa, right? So that's just giving you some insight on what the market is doing overall, how it fills into our sentiment. And then let's go ahead. So this is on the Wealth Catchers website as well. We do have articles on there that's inputted from CNBC and other names. You have some of the latest market news on there. Again, try to keep everything in place and in house. So in one spot you can go to get your tools, get your information, your news, and all that. But we're talking about inflation right now, so obviously, let's be living on the rock. You know that CPI data had came in and it was at 4.2%. So year over year, that's an increase. And then from last month, it increased from 3.8%. So inflation is going up. Obviously, that's not a good sign. And as you see here, we're at 4.2, and then read further down, further into the article, we're going to start seeing like how the war that's going on in the Middle East, the Iran war, is finally coming into play, right? So we have the oil shock in the Middle East, and then that's raising gasoline and other energy prices. So if you've been paying attention, you obviously know that, cost of airline tickets have gone up. You're paying more at the pump, but those numbers fully didn't reflect yet into the data, right? Because again, this is lagging. So when we felt those shocks right away, basically you saw gas prices go up overnight. You saw the fares you're paying for your airplanes go overnight. And obviously you have no choice but to spend that money, right? We need to transport items, goods, people. You're going to spend the money regardless. So all that hasn't been reflected yet up until this point. And now we're starting to see it show up in the numbers. And obviously, summer's around, like we're in summer right now. Usually people are doing what? Vacationing. Or if they can afford it, they're trying to do that, right? So we're obviously going to see potentially go up even more. And also, too, the war hasn't been settled yet. It's always a different headline. We're close to, ending the war. Then it's like there's more strikes. Or we're close to this and that situation. Deal fell through, right? So same way the market is kind of having that little whipsaw situation it had the past few sessions. You can let the whole war situation has been a whipsaw. It's one day it's a good headline, the next day it's a bad headline. And this, the longer it draws out, obviously it's going to have long-term effects on prices, how much consumers can afford. And again, we're going to pay the price because we need to pay the price, right? We have no choice. Whether gas is at $4 and change or it's at $2 and change, you're still going to go to the pump, swipe your card, put the gas in your vehicle because you got things to do, places to be, right? So that is a very crappy situation that many of us are dealing with, right? And then it reflected in the numbers is also pretty alarming, right? Because now it's showing that it's catching up. And then we're going to see here energy accounted for more than 60% of the monthly increase. So that just shows you how much of an impact it had, this oil shock and then this increase in gasoline prices and things like that. So these things are going to have a lasting impact on us. And then some things also don't help out as well, right? The tariffs that were imposed, right, by the administration, even though some reports are saying that's probably trailing off a bit, but we still can't negate the effects of those tariffs, right? There also wasn't something that's going to happen right away. It's drawn out long-term effects that eventually catch up to you and start showing up in the numbers and things of that nature. Obviously, we have the AI spending boom, which is raising costs in certain categories. As we know, electronics and electricity. So, a lot of people who have the data centers being built out to them is charging them more on their grid in terms of what they're paying for electricity in their areas and their homes. Electronics, depending on what you're buying, obviously we know what happened with memory. Those for RAM, prices went up through the roof. If you're just trying to buy some memory for your regular laptop or PC, you basically got priced out the market because all that is now going to AI data centers and things of that nature. So this report has a big impact on is because next week we're going to have that first meeting with right here with Kevin Warsh. As we know, Kevin Warsh got elected or got nominated or whatever it is, placed as the head of the, Federal Reserve, right? Jerome Powell, did his thing during his time there, but, time's up. Now Kevin Warsh is in. So what he's going to be doing, how he's going to be leading the Fed from now on is going to basically, you could say for the most part, garner how the rest of the market is going to be and how things are going to react, right? A lot of people still have that feeling like he's going to listen to what Trump says, things of that nature, because he was handpicked by Trump, but also Jerome Powell was also handpicked by Trump as well. So again, you want him to obviously act in the best interest of, what's going to be best for the dual mandate, right? What affects employment and also what affects controlling price, right, in terms of inflation. So obviously inflation, it seems to be running away right now. So strong stipulation that the interest rates are not going to get cut, right? Because also we have the job numbers that came out. So job numbers came out and they were better than expected, right? So it looks like, unemployment, things of that nature don't have as much of a problem as it may be perceived. So if jobs are being added, right, or jobs are going up in terms of people getting employment, it doesn't make sense to cut rates in a situation like that. And then for what was it? And for inflation going up, it doesn't make sense to cut rates either, right? So very strong chance that it's going to be holding steady on where rates are currently at. And then even paints a better picture for rates being hiked. So that's where the real fear comes in, because if rates get pushed up, then money becomes more expensive, right? So we're going to see what happens with that. And then we're going to go over to the Fed Watch tool. Let me just see if I'm missing anything here. We're going to hop over to the Fed Watch tool to see how it's being priced in terms of these rate cuts and these meetings coming up. So for right here, just talking more about oil and consumer prices, and what we talked about earlier, airline fares being up 27%. Let's see here. And then this one over here says oil prices could jump to $140 per barrel or higher. So we've seen the oil drop down recently. I think it's about 85 barrels, probably lower than that. Obviously, we were at the point where it was at about 110. I think it topped out at. So we did see those swings. But also, too, when a deal is made, right, or when an agreement is put in place, we still have to deal with the catch-up process. They can make a deal tomorrow, but then we still have weeks of time that needs to pass for everything to get back on track, right? So that's another thing too you have to factor in when we're looking at this. But that's the rundown on inflation right there. Obviously, it came in hotter than expected. Definitely looking at a, pause on the rates. So it's going to be just staying where they're at. They're going to be held steady. That's pretty much what's going to happen. Rate cut is probably like out the window for the foreseeable future. And there's a strong chance there may be a rate hike. So let's go to the Fed Watch tool. So the Fed Watch tool gives you the probability of what is going to happen with rate moves. So you just type in Fed Watch tool on Google, and the first link should be it up there. But when you get to it, and this is for the most part how you read it, when I go on here, this is the things I pay attention to. Obviously, the date is that Fed meeting. So you have the date that's coming up June 17th, then you have July 29th, September 16th, October 28th, December 9th, and all these will show you the probabilities. So up here, always going to show you, well, it's not letting me highlight it, but current target rate is 350 to 375. That's it, basis points, but 3.5% to 3.75% is how you read that. So you go over here, you see 98.4%, and you see 3.5 to 3.75. So it's basically saying there's a 98% chance that rates are going to stay right where they're at the current target. And then there's a 1.6% chance that they're going to be cut by 25 basis points to 3.25% or 3.5%. So that's basically how you read it. And then if you want to see for the next month, or the next meeting, I should say, because you see that, you put it in your head, it's a wash. We already know rates are going to be steady, stay where they're at. And then as you go further down the months, you're going to start seeing the data start to skew and become different. So for rates to be held steady next month, there's an 87% chance. And then over here to the right, you see this little guy pop up over here. It's 10% chance that rates might be hiked by 25 basis points, right? Then you go down to September, you're going to start seeing it skew even more. So 61% chance of rates being held steady, then this becomes even more larger portion of probability. There's a 33% chance that rates are going to get hiked come September. And then this guy starts popping up here to be up 50 basis points, so 0.5%. So there's a 3% chance that'll be a 50 basis point hike come September. Then you go to October, obviously, as you go down the line, there's a basically 50% chance rates are still going to be held steady. There's basically a 40% chance that rates are going to be hiked 25% basis points, and then a 9% chance they're going to be hiked 50 basis points. And then for me, I just took it to the end of the year, to December, to see what it looks like towards the end of the year. So by the end of the year, it's being, and again, this changes back and forth constantly. So as of right now, on today's recording, today's June 11th, as of right now, for December 9th, by December 9th meeting, there's a 32% chance that rates are going to be steady. Current levels right now, there's a 42% chance that we're going to have that one rate hike. And then there's a 19.8%, basically 20% chance that by this time we'll have two rate hikes of 25 basis points each. And then there's a 3.7% chance that we're going to be up three rate hikes. So 25 basis point hikes. So basically 0.75% up from the current levels that we're currently at. So basically, market is definitely looking at holding steady or price hikes, right? We're not looking at rate cuts. They're pretty much a wash for the year. So that's the intake on market sentiment in terms of the fear and greed tool, inflation, and the Fed watch tool. So we're going to go dive into the charts. We'll start off with indices. Already took the time to go through and chart everything out. So let me get this guy out of here. So we're going to start off with the Dow Jones, so DIA. So we see here on the daily chart, definitely have this large gap here. So this gap is, let's see what it says, from 475.38 to 466.78. There's an opportunity that it may fall down here to fill this gap out. We did see a couple sessions ago on the 5th, we did hit an all-time high. And then, Dow Jones is now, I think, traded below 50,000. And then our first opportunity here for a key level or key zone is that 50-day moving average. That's 493.98. Also marked here, RSI was hit back here. It hit that over bot situation. Then to that little dip just to ride up higher, hit all-time highs, and then we sold off. So I'm gonna look at the weekly. Weekly, nothing too telling on the weekly that's gaining too much attention here. Only thing I would say here for the weekly, we know back to when we bottomed out in March, is right around that 72 moving average. So 458.37 is where we could look to as another point of it hitting there and reversing back to the upside. And before that, we have 474.75. You can touch that 50, get support there and ride back up. So let me go ahead and look at that for you over here. So I did go to the stock tool on thewealthcatchers.com. The link will be down below in the description. So we also have it marked out over here. 10% is that number I like to look at. Again, 10% is my correction number. That's usually how it's viewed, as 10% is correction. 20% means you're in a quote unquote bear market for that particular name or stock. So a 10% number, so we're at $500.25. So 10% off of that is $465.98. It's a good opportunity to go ahead and start looking at building position, nibbling, and same thing here. Daily, we're at a key level already. So good opportunity to go ahead and start trying to, if you care about being in Dow Jones, you like that specific index, start paying attention to it around this level. Again, we do love the 100 is what we really care about. Obviously, we're still pulled back away from there, but you can see 100 is kind of in line too with that 10%. So 100 is saying 449.73. 10% off is 465.98. So pretty close to one another. So let's go over to our next thing just while we're here. So SPY, obviously that's the S&P 500 equivalent and representation of the S&P 500. Our 10% number for that is $684.36. As opportunity to go ahead and get into that name. See, year to date, we're up 6.2%. We're about 4.6% from the highs. Again, still above these moving averages over here. And then again, for the weekly, we're definitely going to be way above those because, as we all know, market has been running and we have been enjoying a nice run up. And the pullback, even though the headlines are trying to make it seem like, the sky is falling, but pullbacks are healthy. Pullbacks are necessary in terms of the long game when it comes to investing, right? So we have SPY here. Go ahead and zoom in on that. So kept the 253 over here marked out because last time, again, this is where we bottomed out and then the rally began. So I'd like to keep that as a reminder there. Same thing over here. We have the same gap type situation that we saw in the last chart with Dow Jones. So SPY, this gap is 671.81 to 660.07. So we have that opportunity there for it to go ahead and fill that. And it to get down here is very possible. On the daily chart, these situations are more likely to be able to be hit in terms of hitting moving averages. So the 50 right here at 719.32, definitely an opportunity to pay attention to there. I wouldn't say that's an opportunity to go ahead and, start building position in, but we can look at that as some type of support. If it bounces off of there and goes sideways or continue to go back upwards, that'd be a good sign in terms of the trend being still intact, right? Because 50 is usually a powerful trend showing that the market's still going upwards or that trend is still towards the upside. But if we break below this and close, obviously next thing is going to be falling to the 72, then the 100, 200, and then, like I said, 253, and then going back into this gap to fill that up, right? And then we've seen obviously here RSI is marked out down here, seen again how we dropped quickly, right? So again, we had a nice quick run up for the most part if you consider the course of what was it, about 6 weeks. But obviously, you know how the saying goes, you take the stairs up, take the elevator down. So you can see this sharp drop. And I think looking at the S&P 500 is a good indication to look at how sharp this really was. RSI, being in overbought territory, quickly dropped in a couple of sessions down to below 50, right? So we're currently at 40 on the RSI. So it definitely showed you how quick that drop was. So you don't want to be in a situation where you're catching the falling knife. So I would say just let it fall to a key level that you like. And obviously the dip could keep on dipping, as the saying goes. People say that. And then you run out of money to keep on buying the dip. But again, that's what we talked about before in the past, buying in tranches. So you have a certain amount of money you have allocated that you want to spend, and then at each key level you deploy capital into it, right? So whether that's using your 10%, your 20%, or a combination of using that with your moving averages, and also with this situation here with the fill gaps, you can combine all those and develop a plan about how you want to deploy capital, right? hey, I have $1,000 here. I want to make 4 purchases over the course of, going through these key levels and opportunities when it comes to this name. So we got SPY over here on the weekly. So weekly again, nothing too crazy to write home about. So see over here, the 72 was a good opportunity there back when it bottomed out. So 646.16. And again, hitting that 50 at 676.86 will be a good opportunity for support right there. And then hold it and continue to ride the price upwards or go sideways and consolidate. So that's our quick update on SPY. And I'll even go over, let's see what it says about stock analysis. It says buy on here too. Let's go see what it says for Dow Jones buy. All right. I didn't get a chance to look at it over there, so I was just wondering. All right, so for QQQ, we see here, obviously, it's going to be the name that sold off the most because, again, it's tech, more volatile, and it's a tech-heavy index. So we see it's 7.3% off from the high, pretty close to that 10% off, right? So 673.78, about $20 away. So very close to that situation of being in correction territory. So what we see over here for the moving averages, still a different long ways to go for the 100, 200, 253, and 400. And obviously for the weekly, nowhere near the situation. We need a 24% drop in price to even get something decent on the weekly, right? So that's when someone isn't going to probably have the patience to wait for a drop like that. You use your entries on the daily for that. So let's go over to QQQ. Let's go look at the daily. Where are we? There we go. And then you're going to see here, all of them going to have pretty much the same gap. But the moving average situation may be a little different. So again, 253 marked out from bottoming out. And then we have that gap situation to fill for QQQ. That's 601.27 to 588.71 is that gap. And again, daily chart, this is definitely doable. We could definitely fall back down to those prices. 50 is support. We're looking at 676.27 is what we're looking at for support on the 50. So it does suck. We did hit that all-time high up here, and then we see it was that 1, 2, 3, 4, 5 sessions of basically just trading straight down. And then you see with the RSI how we were in this overbought territory for a long time. So this is, yeah, very long time here. It's about, I think, 6 weeks here of being overbought. So obviously time was going to come eventually where we're going to get this pullback. It's just, you need the red days to enjoy the green ones. So you roll with the punches. And again, it only sucks if you're that person who bought, as I always say, up here at the all-time high. So same story for here. As we look at the other past indexes or indices, same thing for Qs, right? That 72 was the last support when we bottomed out back in March. So that's 579.38 currently right now for that 72 moving average. For the 50, definitely looking for it to hit there, go back up. That's 614.48. So that's how the Qs are looking. Let's go ahead, go over to the next one. So we got IWM, which is the small caps. So that's our Russell 2000. And Russell 2000 actually is holding up pretty nicely in terms of how much is down from the high. It's 3.7% down from the high, right? So these are small cap stocks. Definitely something you expect more volatility from. But if we see rates get hiked, this is going to sell off hard because, again, these are smaller companies that need to kind of borrow money, and the lending rates in terms of the financing rates, what they're paying on their money, things like that, to go ahead and get these loans, to do their research and development, to invest in whatever it is they need to, their teams, their companies. They basically need access to cheaper money. They've been okay with the rates as it is right now because we've been quote unquote higher for longer. That's the term. They've gotten pretty much adjusted to that, right? And then also too, there was a speculation of we were expecting rate cuts. And then now, okay, rates are being held steady. They can live in that environment. But if rates start getting hiked up, it's not going to turn out well for these guys over here. But you can see year to date, they're up 13.4%. You seen that when we go back over, who was it? Yeah, when you look at the S&P 500, 6.2%. So them and QQQ, 13.1%. But for them to be 13.4, they're basically leading the market as a small cap. So that's a very good sign there, right? And also to a sign towards, breadth being somewhat not as narrow, right? So breadth, they call it breadth expanding, right? More names in the market are, being participated in, stuff like that. So definitely we do see this involvement behind the small cap stocks and names out there. But for them, still 10% drop for them is 263.59, right? And again, this could happen quickly for them because they're small cap names, they're way more volatile. That could happen quickly for them depending on what goes on with this rate hike situation and what comes out with that. But for higher for longer, I don't expect, they've been in this environment for a long time. I don't expect them to sell off because of that news when that report comes out. And also too, is already being factored in that we're not going to get any rate cuts. So for their chart, let's go ahead and look at that. Switch over to daily for them, RWM. So for IWM, again, their situation of bottoming out was back here for of March was the 200. So if they were to go ahead and hit 200 again for the moving average, that is 256.27 should they try to repeat history and go back down there again, which is very doable. 50-day moving average is 276.54. So again, stay above that. Trend still intact. Everything's still going right. Gap to fill is 258.19 to 253.59. So again, price usually does return back to the gap to fill that one. We did have another one here, but this gap was already filled out. Why I didn't mark it out? It was already filled. So this one still needs to be filled. Then let's go over and look at the weekly for the small cap IWM. So weekly over here, see here that we never hit the 50-week moving average. We got pretty close to it back here when we bottomed out. But to get close to it again, it's 251.17. But again, just last week we had a new all-time high in IWM. Again, they're 3% off from all-time highs. Very, very strong, very positive outlook on it as of right now, right? This could definitely change very quickly depending on news around rates. But IWM has definitely been a surprising winner in terms of how resilient it's been in holding up. So on to the next one. We got RSP. So we know RSP is the equal weight. So everything inside this ETF is equal weighted, right? So everything has the same impact on terms of how it's driving the price for this, right? So this gives you a good representation on the overall health of the market. So you can see here, same thing. Honestly, pretty well. As you look at the headlines, oh, the market's down this much. Like today we had a 900 point drop in the Dow, right? So obviously that's alarming. But if you've been paying attention to the market for the past few years, 1,000-point day in the Dow, up or down, you kind of get used to seeing that, right? 2% swing in NASDAQ is kind of like, oh, okay. But it's still the headline. That's just what they still do. Make you alarmed, to make you worried, make you start looking at the percentages, be like, should I sell? Should I not sell? Do I hold? This is like I said, if you're a long-term investor, it shouldn't bother you. Short-term traders, swing traders, it could kind of depends on what's going on for you. How quickly do you need your capital, things like that. But if you're a long-term investor, like I said, 5, 10 years, 15 years, 20 years, it's a blip. But you use these moments of volatility and opportunity to go ahead and build positions. That's how I look at it. That's how I navigate the situation. Um, so for RSP, so just 2.1% from the all-time high, and then to get to that 10% number, to be correction, 189.85 is what we're looking at for opportunity. And then again, for the 100, $200.67. And then for pretty much all of them are almost near them, right? Not really. Pretty much just the 100. It's about 3% away. This needs another about 5.5% to get to the 200. These are still quite extended. And obviously you go to the weekly, we're a long ways away from that being hit on the weekly. Well, RSP is definitely showing the market is still, for the most part, intact, even though we're having all this doom and gloom go on. So let's go ahead. RSP. Put that in there. So same thing, bottomed out here at the 200. That's 195.41. And then here is its gap fill. So the gap is 196.82 to 193.98. And we did see here when it came and got here, came and grabbed some orders here, and then it rolled up, stayed above all moving averages, and just kept on riding up to the top, right? And then hitting new all-time highs ultimately. But there is another little gap up here. So this is 205.41 to 205.04. So just a few cents, right? But got pretty close here last session on the 9th. Got pretty close to it. So we can look to it. It might just be one long wick, come in here, grab orders, and push back to the upside. There's probably not enough in here to make a big difference in terms of how this is going to swing. But who knows? But there are some orders sitting in here that need to go down there and grab. But again, see the 50, 202.75, trading well above it. Trend still intact. Everything's still going good. RSI was signaling overbought over here. Then rolled it out, hit that all-time high. Kind of sold off, but nothing crazy. Like I said, we're just 2% off from the high. So again, great news for RSP, great news for IWM. All right, so here we are on the weekly chart. So RSP, let's see here. Let me zoom in one more time for you guys. All right, so same thing, bottomed out here at the 50. And if we're looking for it to go back to the 50 on the weekly, that's 193.95. And then even looking up here too on how it's holding, it's definitely spread that out. So that gap fills within this candle over here. So again, still holding above everything. And you can see here too, the 50s way down here. It's holding well above it, even on the weekly chart. So trend's still doing well over the long term too. So definitely positive, definitely looks good. So let's go ahead. Hop over to the next one. So gold. So we know gold is obviously a safe haven. People flock to it in terms of times of turmoil, uncertainty, things like that, geopolitical risk, what's going on with the dollar. Pretty much every story under the sun, people are going to flock to something like gold, right? But as we know, after that run gold had, sell-off started happening for it. And it's kind of been this weird situation where people haven't been flooding back to it. But obviously, it's still something that some people should look at to have in their portfolio, depending on what you're trying to do, whether it's capital preservation. Because honestly, the past year and change, it turned into a growth story when ultimately, the main purpose of it is just to, store value. So Obviously, it depends on what narrative you're trying to go with and stick with. But if you're going with the narrative of treating it as a store of value and not trying to use it as something that's going to double or triple your money, then you should be okay. The ones that are going to be hurt are the ones that are trying to use it as a growth mechanism because it so happened to have given you growth like returns in that past year or two when it was doing that crazy run up alongside silver too. Now, obviously, it finally corrected and came back down to a certain level, right? You still way up on it depending on when you got into it. But see here, year to date, gold is down 6% from the 52-week high. Again, as I was saying, violent, not even correction, quote unquote bear market, right? 26% down from its all-time high or its 52-week high, right? So that is a strong drop. But again, someone bought here at this price, right? Someone just couldn't wait, needed to buy. And they're down almost 30% on that position just because of that, right? So obviously we're at entries, 10% off, 20% off. We're at damn near 30% off. So obviously it's an entry for it. Then daily chart for moving averages, we already hit all these. It's pretty close to, oh no, it's not even close. It's at the key level. Sorry, I misread that. I thought it was a plus over here. So it's at, the 253 SMA and kind of right there by that 400, which is a very strong key level. On the weekly chart, we're still way overextended. So we still have a ways to go for the weekly. Again, this is very key. When you get around the 100, that's probably like one of your better strong buying opportunities. And obviously anything beneath this makes that even a stronger opportunity for you to go ahead and start building position and getting into that name. So gold, let's go ahead, look at it over here. So definitely, obviously, we have some gaps in it because of the swings that happened over time with it. So some of these gaps have some fills into it, but I still marked it out a bit because I feel like it's still gonna be a situation for it. So obviously, we had this first gap over here to the upside that needs to be filled. So that's going on the way up. So let's just start here since we have so way at the bottom. Let's talk about the gaps it's going to need to fill towards the upside, right? That makes more sense. So right here, last trading day, we're right beneath the 253 SMA. So 253 is 385.46, right? And the gap that's here is 388.13 to 384.01. So that's the gap first. It has to fill, and obviously while filling that, it should control and break this 253 SMA, close on top of it, which is going to treat it now as support, which is a good sign. Then it can move on to the next SMA, which has a gap within the SMA, which is also good. So then after that, the next gap is 408.75 to 404.62. And that SMA is 405.86 for the 200 day. So again, it breaks those levels, gets above this 200. That's another positive sign. Then after that, it's going to need to hit the 50. And also the gap that has the 50-day moving average in it is 426.47 to 419.05, with the 50-day SMA being 423.29. So that's if we're going to see it push back to these levels, right? Which it could, but obviously this is supposed to be a capital preservation play, not supposed to be a growth play. So for it to run back up to this, it might be a slow, methodical grind up because again, this shot up like crazy, and again, violently got pushed back down, right? And depending on where you are in that cycle, you could be happy with your trade or your investment, or you're pretty upset that you followed into it. But these are the gaps. The next gap up is 443.77 to 428.25. And then those SMAs 430.98 and 439.04. 439.04 being the last one it has to break. So basically, you get above that 439.04, you have finally gotten above all the moving averages and pretty much going to be stable and just keep trading up. That's the goal. They're able to hit and break above all those moving averages, that's good for it. But if it continues, like it's been on this downtrend here, it keeps on trading below each moving average and falling below. Then eventually you kind of see the green line here, the 50. This crosses our 200 to the downside, then that becomes your death cross, which is a bearish sign. So then that adds more to the story about the price being suppressed and going to have a harder time to trade back up. So let's go ahead and look at the weekly. So for our weekly, we are sitting right at the 50. You can see right here, right at the 50. And the 50 for the weekly is 389.99. So basically 390 is the 50 moving average or 50-week moving average. So good hold there. But again, name ran up so hard, might even push down to this 72, which is 359.20. Right? So if you're looking to get into the gold, I probably would be focusing on those weekly entries for it due to the fact of how strong it ran up. That's just my opinion on it. Obviously, not a financial advisor. Do your own research, all that good stuff. So let's go look at silver. So silver is going to pretty much have the same story. Obviously, they ran up in tandem. Silver being more explosive, right? But also the drawdown. As I talked before about the drawdown, it's going to be way more impactful than gold, and you see it here. So year to date, down 12%. That 52-week high drawdown from a 52-week high, 47%. So the person who bought out $109.83 chasing this silver trade is down 47%. That is disgusting. That's honestly like makes me sick to my stomach looking at that, because it's so avoidable. You don't need to chase. Now the person who is getting it now at 47% off, they can still draw down more, but are you going to most likely draw down almost 50% again? Probably not. Probably not. Because again, you buy at key levels, key moments of support. You can see here, these are all support levels. We're 20% below this 100. We're 5% below the 200. And again, if you were to just wait to the 100, hey, we could probably get here again. All right, so 42.95. So back to what I said, 57.66 to right here. So about 34% needs to kind of get shaved off of there for you to get back to, what I would consider very good. So that's the 100 week SMA. So it just sucks because damn, you bought up here chasing, and then for that to happen just because of I blatantly just call it greed. All right, you're just being greedy and chasing the stock and chasing the name or chasing the commodity, ETF, whatever the hell it is. It's just we have to get away from the greed and chasing and just let price come to you. So that's why you go ahead, mark it out. You don't have to chart. You could just, again, grab a calculator. What's the 52-week high? What's the all-time high of this name? And take 10% off. Take 20% off. Cool. I'll buy at those levels. Or you can do three things: 10%, 20%, and 50%. Those are your, and you can be done with it. And then along the way, dollar cost average. That's why I don't know, it just rattles my brain. But obviously, where we currently are with the silver trade, we are below pretty much most of the moving averages. Only ones we're above are the 253 and 400. So 200 is $60.98. Got to get above the top of that. And then after we get above that, its level of resistance is going to be 66.04 to 64.29. That's the gap it needs to fill to break above that. And obviously, break above your 50 is 72. And then our next challenging gap over here that needs to be filled is 74.14 to 70.24. And you can see also here we are oversold on the RSI. So yeah, silver has been beaten down bad to a pulp. So one good thing about this, you can see here, you guys opportunity. We are so close to the 50. So 56, 53 for silver. That is a good sign in terms of buying opportunity. Because the last time we were near it was way back here. And that's 2025. Was that March, April? Yeah, March, April 2025 was right when we was at the 50, and the prices back then around $30 to $27. So for it to hit the 50, and they can hover around there, but last time it was there was last year around March, April. So it's got an indication right here, maybe a good opportunity. It hits that 50 or it kind of gets below it, 56, 53. Probably a good opportunity right there. So let's go ahead and close out with Bitcoin, right? Excuse me. So Bitcoin, obviously the story with it, we all saw Michael Saylor, basically the face of Bitcoin, or, they made him the face of it now. He's kind of like never served Bitcoin, never served Bitcoin. Then he ends up selling some Bitcoin. It's like a drop in the bucket. I think it was like 32 Bitcoin he ended up selling. Market went crazy. Everyone started selling. And then because, this guy kind of built his whole business is based on Bitcoin in terms of like all they carry is Bitcoin. He developed some type of Bitcoin yield product, how they're able to leverage money. Like he's done this whole Bitcoin ecosystem type thing of how he's trying to run it. And it's like they're basically a Bitcoin holding company. And again, he's like the face of Bitcoin. So for him to sell, even if it was a small amount, it made it a frenzy in terms of everyone else started selling, right? And then Bitcoin dropped crazy, and then he turned around and then it went ahead and I think bought like 100 Bitcoin or something, or some crazy amount he went to go buy. Maybe it was 1,000. I don't know the exact number. I didn't pay attention, but these are the type of situations where the game's the game. You going ahead and making your trades, making your investment based off of what whales are doing, based off of what talking heads are doing. That's on you. You still got to develop your own thesis, your own story, and move based on you. Yeah, I understand following. Oh, Berkshire Hathaway, Charlie Munger, he did this when he was alive, or Warren Buffett did this. Carl Icahn, Bill Ackman, Michael Saylor, Elon Musk, all these people you're thinking of in terms of investing, stuff like that. What are they doing? What have they done? Stuff like that. Good, take into account, but doesn't mean you should act on it solely because of X, Y, and Z. They sold, so I'm selling. They bought, so I'm buying. No, have some discernment in what you're doing. Think for yourself. Use that data, add it to more data that you accumulated, and then stop acting off of what everybody says. I just don't get it. You let yourself get tricked out your spot. So he obviously had an opportunity to go ahead and buy it at a cheaper price because y'all like, oh, he sold, and go ahead, he bought some more at a cheaper price. That's just what it is. But anyways, fear and greed for Bitcoin is at 15. Obviously, extreme fear. And I like to look at the crypto market cap because this is always interesting to me. Let's go look at all time. This is always interesting to me because I feel like when it usually gets to around that 2.5 trillion or lower, I feel like it develops an opportunity to go ahead and buy, right? So You can see here 2.59. This is back in 2024. Hovered around there. So it's around the 2 trillion, 2.5 trillion, ran all the way up, hit that 3.7 trillion, then it fell back down. Obviously, traded sideways around 2.81, 2.5 trillion. This opportunity here, then traded all the way back up, hit another all-time high at 4.2 trillion. Then it came back down. We're at 3 trillion here, 3 trillion, then another leg down. Now we're back to that 2.5, 2 trillion area, right? Now we're at 2.15. So, not to say that it's going to repeat the same thing like it did over here and rock it back up to 3 trillion, 4 trillion. But I just noticed that's what's been happening with it lately, right? When you look over it on these cycles. So it could dip back below 2 trillion. I look at that as just, that's just a better opportunity. If you believe in Bitcoin, right? I like to look at the crypto market cap number because obviously Bitcoin moves the market. Because Bitcoin sells off, everything else sells off just that much harder. And then so let's go look at the chart for it. So with Bitcoin, I'm doing the whole, did it before in the past, slash BTC. It's basically the futures type Bitcoin chart because, Thinkorswim doesn't really have Bitcoin itself. And I try to go do it on Robinhood. I just don't like using Robinhood Legend. The charting system is nice and fluid and everything, I guess. But I don't know. I just, because I'm not used to it, I didn't feel like dealing with it. I tried making, my little lines and all that stuff. I'm just like, no, I can't do it. So we're just gonna do this. So on the daily chart for Bitcoin, obviously, major oversold beneath all moving averages. Following my situation, finally consolidated down here the past couple sessions, but again, just has been, pretty much a shit show for them. We do have our gap here, 81,810 to 79,942. So that gap was filled back here, right? So all those orders were grabbed, fell down after that. So, and then you're going to see this gap, how it continues, to play on as the story goes. So let's go over the weekly. So weekly, as you see down there, we have a much larger gap for another story later on for us to look at. So weekly, same thing here, below majority of the moving averages, but found some solace here at the 200. So the 200 is, the number will pop up, I'm blocking it, 61,475. So we kind of found some support there, and we almost touched the 253, which is 58,601. So kind of in that range right there of some type of support, stability. Let's see how long it lasts. Again, this is on the weekly. And going back over here to that gap, see how it was filled again, even on the weekly. So for Bitcoin to go ahead and move up, we obviously wanted to go back, fill up this gap around here, around that 81,000 to 79,000, break past that. And then its challenge up here is going to be 88,983. So that's what we want to see on the weekly for it to break that, get above that 100 weekly, and then stay there. So let's go over to the monthly. So, for Bitcoin, I like going way out. I mentioned this before in one of the past videos. I like to go out even further than normal. So I'll even go to quarterly on Bitcoin. So the 50, we just hit the 50 on the monthly for Bitcoin. So the 50 is right here. So that's 60,138. So we just touched it right here. And the month just started. So we're 11 days in. Obviously, we have until the end of the month to see how this goes. And obviously, where next month opens. Ideally, next month opening, above the 50 would be great. keeps us still in a good situation in terms of still in a good trend. Obviously, we've been selling off, but doesn't break down completely because we haven't fallen below a key moving average. So far, we just touched the key moving average and we're still holding strong. Depends on how the rest of this month plays out. And then on to the next one. If we open below here and then close below it, oh, that's some bad news there. Now the quarterly is, I don't want it to be maybe come off as fear mongering or whatnot. Definitely might get some people worried about it. But I just noticed it. I was like, that's a pretty crazy gap. So we had this gap way back here that was established back in, what is that, 2023? Yeah. So the gap between, October 2023 and July of 2023. So the July jump from July quarter to the quarter for October. So what's that? Q2 to Q3. That jump created this huge gap. And this gap is between 40,247 to 29,641. So that gap is there. So basically saying there's like basically orders in here. That's how you should look at the gaps, as orders are sitting here, liquidity, things of that nature is sitting right here in here and it needs to be filled because usually gaps get filled. So if we come back down here, which isn't impossible for it to happen, it can't happen, right? Things can go to zero, right? That's just how it is with assets, right? They can go down. They don't always need to go up. But so basically saying that we have another $20,000 to go if this was to continue to go down, just to get the top of this gap. And to get to the bottom of it, that's basically another 30,000 in total to go of drawdown. Who knows? But that gives you that window of 40K to basically 30K. It could continue to go. And like we said, how this has been going lately, drawdown, drawdown, drawdown. But we'll see how that plans out. Obviously, we don't have the moving averages on here, so we're just operating off of that gap. But if we can hold some support here, this is 56,910 based off of this quarterly candle back in April of 2024. We'll see there. And obviously, we have the doji over here. And then I know this candle we mentioned before, one of the past videos, 58,945. So these are pretty much close to each other in terms of, support levels. So far this quarter, our low has been 59,275. So we haven't gotten close to the low of this quarter back here. But let's see how well we can hold on to it. But it's just something that was interesting to me to see that big gap on the quarterly. So we'll see how it all plays out. But yeah, overall, that's the overall wrap up of everything. Kind of a big overview, market outlook from all the major indices, obviously into commodities, and then to Bitcoin, inflation, all those good things. So please remember, you can always go to the website, thewealthcatchers.com. Go ahead and get some information there. Got articles on there, evergreen content. Got the latest market news. Got those plugins on there. Got the tools to use. Obviously, today we went through using, as you can see here, stock analyzer tool. Pretty much just used it for the entry point. But again, stock analysis on there. You got the SWOT, obviously competitors. So use that to go ahead and, do your research with it. And again, we went over the FedWatch tool, how to use that. I can add that to your tool belt to understand, what's going on when it comes time to pay attention to things around rates and, talk about Bitcoin. So definitely give a nice, well-rounded situation to understand what's going on in the market. Hopefully it helped you guys get some sense of what's going on, and obviously looking at the charts, things of that nature. If you have any questions, leave any comments down below. If you have anything to ask me or want to discuss about, You can also send an email to thewealthcatcher@yahoo.com. And you want to talk to me about privately. And again, just want to thank you guys. Thank you guys as being, wealth catchers. That's what we all are here to do, catch wealth. And appreciate y'all stopping by. Y'all have a great night. Thank you.